You walk into a bank with a simple question. I want to borrow $200,000. The loan officer doesn't ask about your dreams or your potential. He doesn't ask what you're planning to build or what you hope to accomplish. He asks one thing, and only one thing. How much do you make? It's a simple question, but the answer triggers something. A computer runs a formula. A complex statistical model trained on millions of historical data points. And that formula tells them exactly how much they're willing to bet you'll earn over the next 30 years. Not what you could earn if you took risks. Not what you might earn if you got lucky or worked harder or took a bet on yourself. What they predict you will earn based on historical patterns. And here's the thing that should make you uncomfortable. They're usually right. Almost spookily right. Which means they know something about the structure of your income that you might not have consciously realized yet. This is the story of how that prediction becomes a cage. It's not dramatic. It's not a sudden trap. It's math applied patiently over 30 years. And by the time you realize what's happened, the structure is too tight to escape. The setup. Marcus is 28, makes $65,000 a year. One day, he goes to buy a house. The bank runs their models and comes back with $380,000. That's the maximum they'll lend him. Marcus feels validated. But what actually happened is different. The bank has made a prediction. They've calculated he'll make roughly the same income for the next 30 years and calculated how much obligation he can carry. A $380,000 mortgage at 6.5% is roughly $2,400 a month. That's 44% of his income. And for the next 360 months, the bank has engineered a situation where Marcus cannot afford to be unpredictable. He cannot start a business that might fail. He cannot go back to school. He cannot take a pay cut to work somewhere better. The bank has placed a precise bet on Marcus's predictability. Through the mortgage structure, they've aligned all his incentives toward making that bet correct. Now let's look at how this system was built. The mechanism revealed. Here's how the system actually works. And understanding the mechanism is crucial because it's both elegant and relentless. Banks collect decades of data, accumulated historical records of millions of borrowers. They track everything. They know how people with certain income levels behave across economic cycles. Who pays on time? Who doesn't? Who refinances? Who moves to a different bank? They track which demographic characteristics correlate with default. Which job types are stable, which are volatile. They feed all of this into sophisticated statistical models that become remarkably good at one specific prediction. What is the maximum monthly obligation this person can handle without defaulting? But here's the subtle part that most people miss. That prediction is based entirely on past behavior, on what people historically did, not on what they could do, not on what they want to do, not on their potential or their ambitions or their capacity for growth. The model looks backward and extrapolates forward. It says, people like you with your profile historically earned roughly the same amount for the next 20 to 30 years, and that's what we're mathematically going to assume about you. The accuracy is impressive. It's genuinely good statistical work. But accuracy and fairness are not the same thing. Second, they package that prediction into a loan product. They take Marcus and thousands of Marcuses, people with similar profiles, and they bundle that predictable cash flow together into financial instruments. They sell these instruments to investors, pension funds, insurance companies, other financial institutions. Suddenly, Marcus's mortgage isn't a simple loan between him and a bank anymore. It's transformed into a financial security backed by millions of monthly payments from people exactly like Marcus. The bank has shifted its business model. They're no longer in the business of lending money and holding the risk. They're in the business of identifying, quantifying, and securitizing predictability. They find people whose future is stable and bundle that stability into products they can sell. Third, and this is the critical part, they've created a system where your income predictability becomes your financial ceiling. This is where theory meets reality.
Let's say you make $100,000 a year. A bank will typically lend you 3 to 5 times your annual income for a mortgage, so you get approved for $300,000 to $500,000. That seems generous. It sounds like the bank believes in your earning potential and your ability to grow. But actually, no. They're being extremely conservative. They're assuming you won't earn much more than $100,000 for the next 30 years. They're assuming normal salary growth of 2 to 3% annually. In 5 years, about $110,000. In 10 years, about $122,000. In 20 years, about $149,000. In 30 years, about $181,000 in nominal dollars, which is way less in real purchasing power when you account for inflation. The bank loans you money based on this conservative prediction of your future earnings, and then they structure the loan so that you physically cannot afford volatility. You cannot afford to take the risks that might actually increase your income significantly beyond that conservative projection. Imagine Marcus realizes he could start his own marketing agency and go from $65,000 to $120,000, or potentially more. It's what a lot of successful entrepreneurs do. There's just one problem. The $380,000 mortgage. His total monthly obligations lock in at 60 to 70% of household income. To start a business, he'd need savings, runway. He'd need to be able to survive on reduced or zero income for 6 months or a year while the business gets off the ground. He'd need to not panic if a major client leaves. He'd need financial flexibility. But he can't have that flexibility because the bank has already structured his expenses so tightly that he can't miss a paycheck. 1 month of missed mortgage payment and he's already falling behind. 6 months and he's in default territory. 12 months and his life is in chaos. So Marcus stays where he is. He gets his safe 3% raise every year. He makes the prediction come true, and the bank wins the bet it made about his future. This is what it means when I say the system uses predictability to cap your income. It's not that banks are evil or that executives are sitting in conference rooms plotting to limit your earning potential. It's that they've built a financial architecture optimized for stasis, for you staying roughly where you are, for the prediction holding true, and then they've made sure that the debt you take on makes defying that prediction mathematically difficult. The system works like a lock that tightens the more you struggle. The hidden math. Here's a critical fact. The entire U.S. consumer lending market is built on one core assumption: income stability. Not income growth, income potential, stability. Americans carry about $4.5 trillion in consumer debt. Mortgages, auto loans, student loans, credit cards, all of it. And every single dollar of that is priced based on predictions about future income. When you apply for a credit card, the bank assumes your income will be stable enough to pay the minimum balance. When you take an auto loan, they assume your income will let you make a $400 payment for 72 months. When you take a student loan, they assume you'll service that debt within a certain percentage of whatever income you eventually earn. The system works beautifully as long as your income stays predictable. But here's what actually happens in the real economy. Income volatility has been increasing for decades, especially at the lower and middle income spectrum. The traditional corporate job with a pension and annual raises and a gold watch at the end, that's increasingly rare. The gig economy, contract work, freelancing, unstable income has become normal. And yet, the entire lending system is still priced as if income were as stable as it was in 1985. This creates a structural mismatch. You're living in an economy with volatile income, but your debt is priced for stable income. You end up worse off. Let me show you with Sarah. She's 34. She works as a freelance designer. Some years she makes $90,000, some years $65,000. Depends on the market, depends on her hustle, depends on timing.
Over a 5-year period, her average is around $75,000. When she goes to get a mortgage, the bank looks at the last 2 years. She made $68,000 and $71,000, so they say you can qualify for a $250,000 loan. Sarah thinks this is probably conservative. On good years, she makes $90,000. So she takes the loan. She buys a house. Then, inevitably, she hits a bad year. A major client goes under. A project falls through. She makes $55,000. Now she's got a mortgage payment that was calculated assuming $70,000 annual income, and she's making 22% less than that calculation assumed. She starts to miss payments. Credit card debt climbs. She's suddenly in the category high-risk borrower. Her credit score drops from 740 to 580, and when she finally stabilizes and starts making good money again, she's got the scar tissue of those missed payments. She's now a person whom the algorithm will never fully trust again.
The system didn't punish her for taking risks. It punished her for volatility, for being unpredictable. And here's what's remarkable. This punishment actually proved the algorithm correct. It validated the prediction that people like Sarah are riskier than the surface data suggests. But that wasn't because volatility proves someone is a bad borrower. It was because the system itself was never designed to handle volatility. The system creates volatility risk where none would otherwise exist. The system is also actively penalizing people trying to increase income. Marcus works for a corporation. His income is stable and predictable. The bank loves him. He's a pristine borrower. His cousin Tony has identical annual income, $65,000. But Tony's income varies year to year because he works as a contractor. When Tony applies for a loan, he'll either get approved for less money or he'll pay a higher interest rate, even though his long-term earning potential is identical to Marcus's. Why? Because the bank's prediction engine is designed to identify and penalize unpredictability. It doesn't matter why the income varies. It doesn't matter if that variation is strategic or temporary. It just matters that it does vary. The vicious cycle. Here's the elegant trap. The bank predicts your income will be stable, so they only lend based on stable income. So you take on debt structured around stable income. So you physically cannot afford the volatility or risk required to actually increase your income significantly. So your income stays stable. So the bank's prediction was right all along. And because the prediction was right, the system feels justified. The algorithm is working. The model is accurate. The whole thing is validated. Risk is low, profits are high, everything checks out mathematically. But what actually happened is far more subtle. The system created the exact conditions that made the prediction true. It's a self-fulfilling prophecy built directly into the architecture of consumer credit itself. The system doesn't just predict your future so much as it manufactures it. And here's what makes it even more profound. The system doesn't just accommodate stable income, it actively punishes income growth. When you take a mortgage, lenders use your current income to determine the maximum you can borrow. If you get a big raise later, if you earn significant money from a side project, the bank doesn't adjust your mortgage payment down. Why would they? But here's what they do watch very carefully: your debt-to-income ratio. If you increase your income by 30% and then try to take out a business loan or another mortgage, lenders will suddenly want you to increase your monthly obligations to match that higher income. It's like the system is engineered to say, we're only comfortable with you having a certain level of financial flexibility. Stay within these bounds. The data proves it. People who get raises tend to increase their consumption and debt proportionally, not because they're making bad decisions, but because the entire lending infrastructure is calibrated to prevent you from just sitting on excess cash, from building financial independence, from using income growth as a way to reduce your dependence on the financial system. Think about what would happen if everyone who got a 30% raise decided to keep their expenses exactly the same and invest the entire difference. The entire consumer lending industry would collapse. The auto loan market, the credit card market, the mortgage refinance market, the home equity line business,
all of it depends entirely on your income growth translating into more consumption and more debt. So the system doesn't just assume you'll stay predictable, it actively structures itself so that when you do earn more, you'll use that earning power to take on more obligations, to stay tethered, to remain dependent on the machine. Here's the proof. The average American household spends 110% of what they earn, not because people are making bad decisions, but because the system is architected to extract every dollar of earning potential into either consumption or debt service. The moment you make more, there's a product waiting for you, a new loan, a credit card, a mortgage refinance at a lower rate that resets the clock.
The bigger picture. Is this a problem? From a pure system design perspective, the answer is undeniably yes. The American lending system has optimized itself for a version of the economy that barely exists anymore. It's penalizing the exact behaviors that lead to economic growth, wealth creation, and opportunity. It's making it harder to take intelligent risks, harder to change careers, harder to build businesses, harder to invest in yourself. But from the bank's perspective, there's no problem at all. None. The system is working perfectly. Defaults are low, profits are high, the models are accurate. Marcus makes his payments, the mortgages get bundled and sold, the money gets recycled into new loans. The machine keeps humming along exactly as designed. The real question, the one that matters, is who actually benefits from this system. And the answer isn't complicated. The people who benefit are the ones whose income is already stable and predictable. The ones who work for large corporations with predictable salary scales. The ones who have professional licenses and established career trajectories. The ones who inherited wealth. The people whose income risk has already been removed from their lives by circumstances of birth or early advantage. The people hurt by this system are trying to build wealth from zero. The risk takers, the ones switching careers and retraining, the ones trying to do something different, the ones who might actually earn a lot more, but only after a period of unpredictability. The gig workers, the entrepreneurs, the artists, the consultants, the contractors, the people trying to do the thing that historically creates wealth. And here's the thing that should make you sit up straight. This system wasn't an accident. It was deliberately designed, not to intentionally harm risk-takers, but to create a stable, predictable pool of borrowers. The banks succeeded in that mission. They created efficiency. They created predictability at scale. They created a machine. And in doing so, they accidentally created something much more significant. A mechanism that actively preserves and reinforces existing inequality. Because if you start with wealth, you don't need banks, you don't need mortgages, you don't need to qualify for anything. You can self-finance risk, you can take sabbaticals, you can invest in your own business without asking permission. You can be unpredictable on your own dime. Your wealth gives you the freedom to take the kinds of risks that created that wealth in the first place. But if you start without wealth, if you don't have a trust fund or a safety net or parents who can help, you need credit. You need a bank to believe in you. You need someone to lend you money so you can buy a house or start a business or go back to school. And the bank will only believe in you if you promise to be predictable. If you promise that you won't do the kinds of things that might increase your income dramatically. If you commit mathematically to staying roughly where you are. The system tells you it's opening doors, but what it's actually doing is narrowing the paths available to you. And it does it so smoothly, so mathematically, so reasonably that you don't notice until you try to step off the path. The closing question. So here's where I leave you. This isn't a problem with an easy fix. The banks won't change voluntarily. The system works. Regulations still fit an old economy. The question isn't, can we fix this? The question is, do you understand how this system is designed to keep you from building wealth? And if you do, what are you going to do about it? Because the system will keep working exactly as designed, predicting your income, turning growth into debt, keeping you dependent.
The only person who can defy that prediction is you. And you can only do that by seeing the trap clearly enough to know which risks are worth taking outside of it.